Persistent inflation, tight commodity markets, and an AI boom are pulling asset prices in different directions, challenging traditional diversification. Welcome to vTalkInsight, Allocator's Lens Daily for May 29th, 2026. Let's start with equities, where record earnings and concentrated AI leadership are colliding with a higher rate backdrop. Equities are still anchored by very strong earnings, even as macro headwinds build. S&P 500 profits in the first quarter beat expectations by about $10 per share, with year-over-year growth around 25% and forecasts for more than 20% growth for the full year. Roughly two-thirds of companies have beaten estimates, and margins are expanding, which helps explain why major indices are printing new highs despite slower gross domestic product and flat personal income data. The catch is that this strength is highly concentrated in technology and artificial intelligence. Recent analysis suggests semiconductors, hardware, and software account for the vast majority of recent United States gross domestic product growth, with some estimates as high as 95%. Capital spending is surging, led by roughly $700 billion of planned hyperscale data center investment, and companies such as Dell and Snowflake are reporting accelerating AI-related revenues and raising guidance. That concentration is showing up directly in market leadership. A small cluster of mega-cap chip and software names, including the largest AI and semiconductor platforms, is driving most of the index-level gains while more than half of S&P constituents can decline on a given day. Fund portfolios are similarly concentrated, and there are growing worries that AI and data infrastructure stocks are entering bubble territory, with calls for a potential 10 to 20% consolidation after the latest run. At the same time, the real economy picture beneath equities is becoming more K-shaped. Affluent households, benefiting from a roughly $75 trillion net worth and heavy stock ownership, continue to spend and support financial sector earnings. Lower-income consumers face negative real wage growth and higher energy costs, which is shifting spending toward essentials and value retailers and raising the risk that any equity correction could feed back into weaker consumption through the wealth effect. There are also early signs of rotation within equities. Consumer discretionary names have pushed to new highs. Some small and mid-caps are outperforming on improved earnings revisions, and value stocks tied to semiconductors are unusually outpacing traditional growth factors. Looking further out, several strategists expect leadership over the next cycle to tilt away from United States mega-cap technology toward small caps, commodities, energy, and international markets such as Japan, Europe, and emerging markets excluding China, even as they still project a secular bull that could take the S&P 500 toward 10 to 13,000 by the end of the decade. Technically, the balance between new supply and demand also matters. Upcoming mega initial public offerings in space and artificial intelligence could prompt investors to sell existing winners to participate, yet projected corporate buybacks above $1 trillion and robust merger and acquisition activity provide offsetting support. With the volatility index sitting in the mid-teens, equity markets look calm even as many expect a 5 to 10% pullback into the autumn on the back of energy shocks, Federal Reserve uncertainty, and heavier equity supply. So allocators will be watching breadth, AI earnings revisions, and the coming personal consumption expenditures inflation print very closely before adding risk. Turning to rates, the dominant theme is higher for longer as inflation proves sticky. Core personal consumption expenditures inflation is running around 3.3% year-over-year, with shorter-term trends pointing closer to 4%, and headline PCE is expected to approach 3.8%, the strongest pace in several years. Federal Reserve officials acknowledge some chance that tariff and energy pressures fade later this year, but they also stress that inflation risks are tilted to the upside, which keeps rate cuts distant and leaves a non-trivial risk that hikes could return if price pressures reaccelerate. The front end of the United States curve reflects that tension. Two-year Treasury yields have risen for 5 straight weeks, and markets are pricing in the equivalent of a full additional hike, even as gross domestic product growth has been revised down to 1.7% and consumption has been marked lower. Some observers see that as an overshoot relative to the softer data, but for now it underlines how hard it will be for the Fed to ease policy in the face of persistent core inflation. Further out the curve, yields are being pushed higher not just by inflation, but also by fiscal dynamics. Governments globally face larger defense and social spending, rising debt stocks, and heavier sovereign issuance, all of which require higher term premia to attract capital and create a crowding out effect. Some longer-term scenarios envision United States 10-year yields normalizing around 5 to 6%, and potentially higher if this new inflationary cycle endures for a decade or more, which would mark a clear break from the prior deflationary era. For multi-asset portfolios, the key change is that the historical stock-bond hedge has weakened. With inflation uncertainty high, episodes of rising yields can now coincide with equity drawdowns, so bonds may offer attractive income relative to equities without delivering the same downside protection as in past cycles. Rate volatility has already picked up, and history suggests that a sudden 50 basis point move in yields over a month can pressure equities, making upcoming inflation releases, fiscal debates, and global central bank meetings critical for both sides of the asset allocation ledger. Credit markets sit at the intersection of strong risk appetite and rising underlying risks. In public markets, credit spreads have ground back toward the very tight levels last seen in 2007, despite elevated inflation and geopolitical tension. High-yield issuance is finding eager buyers, especially for AI and data center-related projects, where around a quarter of new deals are funding hard assets and infrastructure tied to the generational AI capital expenditure cycle. Even within those tight spreads, differentiation is building. Clean, cash-generative credit stories with limited exposure to inflation or geopolitical shocks are well bid, while more vulnerable sectors, including some software names, are trading weaker. Many investors view all-in bond yields as attractive versus equity valuations, but they are increasingly sensitive to duration, sector, and issuer quality given concerns that bonds may not hedge equity drawdowns if inflation surprises again. The more acute stresses are emerging in private credit, particularly around technology. Rising redemption requests in funds with software exposure, along with recent markdowns, highlight fears that artificial intelligence could disrupt some business models and impair cash flows. In Europe, the rapid, lightly regulated expansion of private credit alongside shrinking real bank lending raises broader systemic questions and has sparked calls for a more level regulatory playing field between banks and non-bank lenders. Balancing that, private equity activity is improving. Exit volumes are rebounding, with first quarter asset sales reportedly up several-fold year-on-year as sponsors proceed with deals without waiting for rate cuts. The secondary market is also scaling rapidly, with potential to reach hundreds of billions of dollars in annual turnover, which offers allocators more flexibility to reshape portfolios even as fundraising concentrates in a smaller group of billion-dollar-plus funds. Foreign exchange markets are expressing both geopolitical tension and policy divergence. The United States dollar has firmed recently, gaining around 0.2% on the day and roughly 1.5% since the latest flare-up in Middle East conflict, as investors seek traditional safe havens. That move has coincided with bouts of equity selling and higher oil prices, reinforcing the dollar's role as the first stop in a risk-off episode. Looking ahead, that safe haven premium may compete with growing policy divergence. While the Federal Reserve is broadly expected to stay on hold for now, several other central banks, including in Europe and Australia, are increasingly pricing or signaling additional tightening, which adds upward pressure on their local yields. In Asia, the Bank of Korea has kept rates unchanged but with a hawkish tilt, pressuring the Korean won, whereas currencies such as the Singapore dollar and Australian dollar have shown more resilience against the United States dollar. For cross-border allocators, these shifts mean currency can be a significant driver of total return. The combination of differing rate paths, energy exposure, and tech sensitivity suggests FX will increasingly reflect the same divide seen in equities and bonds, making upcoming central bank meetings and geopolitical headlines around the Middle East particularly important for currency risk management. Commodities, especially energy, remain central to the current macro regime. Brent crude has pushed toward the high $90 area, and United States benchmark crude is above 90, driven by military exchanges near the Strait of Hormuz and persistent concerns about shipping safety through this critical choke point. Physical markets are tight, with oil inventories back near post-Russia-Ukraine lows and gasoline stocks more than 5% below their 5-year average, raising fears that the buffer supporting the United States economy is close to exhaustion. Headline risk around negotiations with Iran adds another layer of uncertainty. Reports of a tentative ceasefire extension and renewed talks have at times coincided with lower crude prices and softer 10-year Treasury yields, as some investors price in a quick resolution. Others warn that without a broader deal, leverage may gradually shift toward Iran as United States inventory buffers erode, potentially forcing tougher choices and keeping energy prices, and therefore inflation, higher than markets currently assume. Beyond oil, industrial metals, and gold round out the inflation story. Aluminum supply disruptions in the Gulf have removed several percent of global output. Government stockpiling and export restrictions are tightening metals markets, and scarcity of key inputs for AI hardware is feeding into broader price pressures. Meanwhile, the United States has become a major liquefied natural gas exporter, but infrastructure bottlenecks limit how quickly supply can respond to shocks, and central banks, led by China, have been steady net buyers of gold, reinforcing its role as a long-term store value in an environment of fiscal strain and geopolitical uncertainty. Stepping back, today's cross-asset picture is one of powerful earnings and AI-driven growth colliding with a stubbornly higher inflation regime and tighter real-world capacity in energy and metals. Equities continue to ride a concentrated technology wave, but the combination of elevated valuations, a more fragile consumer, and higher rate volatility leaves little room for disappointment. On the rates side, higher for longer policy, larger fiscal deficits, and a weaker stock bond hedge are reshaping how duration fits into portfolios, while credit trades at tight spreads, even as private credit and software-heavy exposures show emerging strain. FX is increasingly about policy divergence and energy exposure, and commodities remain the macro fulcrum, with Hormuz tensions and metal supply constraints feeding directly into the inflation and rates narrative. Allocators will be watching the next PCE inflation prints, central bank meetings, and any shift in AI earnings momentum to gauge whether the current risk-on tone can persist or gives way to a more volatile consolidation phase. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.